Hey, welcome back to our channel. We break down tax strategies so that everyone can use them. Today we are talking about a specific strategy for real estate investors called a 1031 exchange. It is not complex and it is not hard to execute, but you do need to know the rules. So today we are going to go over the 5 rules to execute a 1031 exchange. But before we get to the rules, let's talk about what a 1031 exchange is. A 1031 exchange is a tax strategy where you can sell one property and reinvest those proceeds into a new property while deferring those capital gains that you would have paid. The concept itself is fairly straightforward, but there are some nuances that you need to understand to execute it properly and really get the most out of that tax deferral. Now, the first rule of the exchange is that it only applies to like-kind property. The key word there is property. It has to be a real estate exchange. You can exchange one building for multiple buildings, or you can exchange multiple buildings for one building or land into a building. It all has to be under the umbrella of real estate, meaning you cannot exchange stock or bonds or other assets in a 1031 exchange. So rule number 2, there is a very strict timeline. You have 45 days after the initial close of the property to find and identify a new property for the exchange. You have 180 days total to actually close on that new property and finish the transaction. And these rules are very strict. You cannot miss this by one day or your exchange will no longer qualify. Rule number 3, you cannot hold the funds of the transaction. As soon as you gain access to those funds, you're going to have to pay tax. So what that means is that you need to use a third party called a qualified intermediary to hold the funds during the transaction. It's important that you find someone that you trust and who can properly go through the process. Number 4, the value of your new property must equal or exceed the value of the property that you sold in order to get the full benefit of the capital gains deferral. Rule number 5, and this is really key, this only applies to investment property. You cannot run a 1031 exchange on personal property unless you meet certain qualifications, which is usually time. That if you, for example, wanted to turn an investment property into your personal home, you would need to hold that for a certain amount of time after your exchange for it to still qualify for the tax deferral of the exchange before it becomes a personal property. So really, this tax strategy is meant for real estate investors that are swapping investment properties. All in all, it's a really great strategy and it's actually quite simple, but it can be difficult to execute if you don't work with the right person to help facilitate the process. Good luck out there, real estate investors, and happy tax deferring.